Welcome back to Landlord Pass and 3 p.m. BC. I'm Amanda. You've got rent coming in, maintenance under control, and tenants on track. Now comes the part that keeps accountants busy. What counts as an expense, what the government gets to claim, and how much you actually owe. Module 15 is about having one system that works for the CRA, for BC tax authorities, and for you come January. Here's the challenge. Rental accounting is not the same as business accounting. You're not a hotel. You don't charge GST. You file a special form called T776. And in BC, you also have speculation and vacancy tax, SVT, which is its own annual declaration that most landlords get wrong. If you treat rental bookkeeping like a once-a-year event, you're going to lose money. Let me be specific about what a clean system looks like. One separate bank account, rental only, no personal money mixed in. One receipt system. Every receipt photographed or saved digitally, same day. One tracking spreadsheet or accounting software, T776 categories set up from day one, updated continuously, and one SVT calendar reminder for March 31st every single year. Let's start with basic deductions. CRA allows you to deduct expenses that are incurred to earn rental income. That includes mortgage interest, but not the principal property taxes and insurance utilities and maintenance property management fees, advertising for tenants, professional fees, accounting, legal, specifically for the rental strata fees, usually the maintenance portion. You need a receipt for all of it. No receipt, no deduction. Simple. Now here's where landlords get tripped up. The difference between a current expense and a capital expense. Current means it restores the property to its original condition. You paint a room, fix a leaky faucet, replace worn weather stripping. Deduct it immediately. Capital means you're improving it beyond the original condition, or extending useful life in a material way. You renovate the kitchen, upgrade to hardwood floors, add a new deck. Capital expenses go on the balance sheet and get depreciated over time, what the CRA calls CCA, or capital cost allowance. The bad news, landlords often get this wrong. The test is not, does it increase the property value? The test is this a repair or a betterment? If you claim a $5,000 kitchen upgrade as a current repair and the CRA disagrees, you lose the whole deduction, plus interest and penalties. When in doubt, ask. A quick email to a CPA is cheaper than a reassessment. Let me talk about CCA, depreciation, because it's powerful, but it's not free. In Canada, you can depreciate capital items over time. A building falls under Class 1, 4% depreciation per year. Furniture and appliances fall under Class 8, 20% per year. The benefit is lower taxable income today. The cost is recapture when you sell. If you've been claiming $2,000 a year in CCA and then you sell for a profit, some or all of that CCA might come back as taxable income. For that reason, many small landlords avoid claiming CCA on the building itself. They claim it on movable assets, furniture, appliances, but leave the building depreciation alone. There's no rule that says you have to claim CCA, so if you're unsure, skip it on the building. Now, something BC specific. The speculation and vacancy tax, or SVT. If a residential property sits empty or is used inconsistently in a designated area, SVT applies. The rate in 2026 is 1% of assessed value if you're a Canadian citizen or permanent resident. It's 3% if you're a foreign owner. But here's the part that catches people. You have to declare by March 31 every year, even if you're exempt. Miss the March 31 deadline, and the government can assume the property is vacant and assess you for the full amount, even if you would have been exempt. So if you own rental property in BC and you've never filed an SVT declaration, go file one now for last year. Late is better than never. If the property is rented out long enough under the terms of the law, you get an exemption. Keep your lease, rent records, and proof of occupancy together. That's your proof. One more important case. If you're a non-resident of Canada, you live abroad, there are special rules. CRA can withhold 25% of the gross rent unless you file Form NR6, which allows net withholding, where taxes are calculated on actual income, not gross. If you're non-resident, you also have special reporting rules and potentially Section 216 elections. This is complex. If you're in this situation, get a cross-border CPA. Let me give you the operational checklist. 1 bank account for the rental, clearly labeled. Every receipt captured same day. Photo is fine. Store in a folder system organized by month. A simple spreadsheet with column headers matching T776, rent income, mortgage interest, property tax, insurance, repairs, utilities, etc. Update it weekly. Set a calendar reminder for March 15th if you're in BC. That's your warning to gather SVT documents for the March 31st deadline. At the end of the year, hand the records to a CPA. Do not try to DIY the T776 unless you're very confident. Common mistakes I see. Mixing personal and rental expenses in one account. It's a nightmare to separate at year-end. Waiting until December to gather receipts. You've forgotten half of them by then. Misclassifying capital as current or vice versa. When in doubt, ask. Forgetting to file SVT declaration even in exempt years. And claiming CCA on the building without thinking through recapture later. The payoff for being well organized is lower audit risk, knowing exactly what you owe, and making proactive tax planning possible instead of reactive. Keeping things orderly year-round takes maybe 3 hours per month. Dealing with a disorganized year takes 3 weeks. In Module 16, we're moving to the hardest topic, evictions. What triggers one, what forms you need, what common mistakes landlords make, and what the RTB process actually looks like. When you're ready, join me in Module 16, Navigating Evictions in BC.